Hello value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk to you about Palo Alto Networks. Palo Alto Networks is a cybersecurity company. They just reported very strong end of year result, and the guidance for the year ahead is also quite compelling. We're going to dig into that. We're going to talk about some of the positive aspects such as the billings growth. We're going to talk about one negative aspect that I think about on the dollar-based net retention rates, and then we're going to talk about everything, bringing it together and its valuation. So let's just jump right in. So here's the thing. So they've been kind of accelerating over the past 4 quarters, and you can see here in the graph that coming into Q4, top line was up 28% year over year. This is very strong. This is for a company that you remember was kind of like sluggish slightly, and everyone in cybersecurity was just buzzing ahead. You had CrowdStrike, you had Zscaler, everyone was just like doing like crazy things with their top line growth, and there was Palo Alto Networks just kind of going along, and investors were kind of slightly despondent. But yeah, so you can see here that they came out very strong top line growth, and more importantly, the guidance for the end of the year for fiscal 22 is pointing towards 22% year over year growth rates. And why that's important is because you can see here in the graph, so you can see in the green boxes, analysts following the company are kind of expecting this company to dip down in the second half of 2022 below 20% growth rates. But actually, as you can see, the company is actually saying not only is 2021 going to be strong, but we can see here that 2020, the latter part of the year is actually going to accelerate slightly, so that for the year as a whole, they're pointing towards 22%. So that's, a company that's clearly ignited its growth rates and clearly doing more than the street was expecting. Also, I think this is quite a nice graph to look at. So you can see here that the total billings growth for the quarter was up 34% year over year. So if you remember, billings is a forward indication for the company, something that the analysts and investors follow, and it's typically telling you that, okay, this is revenue that's still going to be pre-booked at some point in time, so you want to really be following this number closely, and this number, it's just a beautiful line accelerating here, so there's plenty of runway ahead for this company. One thing that I wanted to discuss is that you can see here the number of active customers is increasing, and you can see that the number of active customers was up 31% year over year. So there's a nice acceleration in the active customers. The problem that I find is that you can see if the active customers are coming up higher and higher and higher, but the revenue growth rates are slightly slower than this means that customers end up churning out. What's more, that Palo Alto Networks' ability to cross-sell to existing customers is not as strong as with other companies. They don't disclose their dollar-based net retention, but you can just do some simple maths, and you can see that if the active customers, although these are just the millionaire ones, it doesn't really disclose the full cohort, but you can just see that if the active customers are so substantially above 30% and their guidance is towards 22%, that means that they're not able to cross-sell us that strongly. This is not a problem right now because you're not paying a lot for this, but it's just something to keep an eye on. This is something that if I was an investor here, I'd be looking to see how the active customer number is coming in the next couple of quarters. As I said, you're not really paying a lot for this company, so it doesn't really matter in this instance, but it's just something for you to bear in mind. Another thing that I want to talk about is that they've been repurchasing their shares, and they've just increased the amount of share buyback they're going to make over the next 12 months. And this is something that I know this kind of jars a lot of people, but as a tech company, if you're a tech company and you're repurchasing your shares, it means you've run out of spaces to invest in new growth rates, and investors typically don't reward that, and it's astonishing because the company is being really prudent with their capital allocation, and they're saying, okay, we think that our stock is undervalued, and we're actually going to be repurchasing our shares, but investors normally just want to see an unprofitable company that's growing at stupid rates, but actually you should be valuing much more a company's ability to bring back its free cash flow and use it adequately. They've been good stewards of your capital. But anyway, the market is the market, and I'm just trying to explain. I'm not trying to justify it. that's why it's only really made like a tiny little line in the press statement. And they know, management knows that the type of shareholder following a cybersecurity company wants them to just be like crazily gaining revenue, irrespective of whether that revenue ever translates into some kind of profitability at the end. As I touched already several times here, so the stock is priced really cheaply. The stock is priced at 7 times next year's sales. That's really crazy for this space. I know it's a hardware company in cybersecurity, but still, this is really, really cheap. So I just wanted to point out some numbers. So yesterday I talked about, did a video on Zscaler. Zscaler is priced at 37 times forward sales. So it's not this year's, it's next year's. So next year's revenues are priced at 37 times. If you don't think that's a nosebleed territory, I mean, I don't know, it's crazy. If you look at CrowdStrike, that's kind of slightly more subdued. CrowdStrike was last year's was last year's crowd favorite, and that was priced at 21 times. It's priced now at 21 times next year's sales. And Okta, I put Okta in here. It's not really in the same group as Palo Alto, because Okta is much more into the identity side, identification and authentication of the user, rather than what Palo Alto is doing, which is really network security. But they're kind of still same cybersecurity stuff, although there's some kind of, one's more of a SaaS play and one's more of a hardware play in the case of Palo Alto. But still, that stock is priced at 21 times next year's sales. So I know that there is a lot of things here that Palo Alto is not really in the same league as the other companies, particularly as I talked already about the dollar-based net retention, and the growth rate is not quite as strong as some of the other players, but it's not entirely justified for this company to be priced at 7 times forward sales. This is something that I wouldn't typically consider. I don't have an investment here because I'm finding still things that are slightly more appealing to me with even better risk rewards. If you want to find out what, come and check out my marketplace. It's called Deep Value Returns on Seeking Alpha. And what I do is I'm not going to replace you. This is not what I'm about. I'm not a place that replaces you as the investor. I'm just somewhere that you can come and get some ideas. If you're lacking in stock picks, you want someone to do some due diligence, you want an investment community to bat ideas off, that's what I provide. I don't replace you. I'm a marketplace that really is about value investing and thinking forward and trying to think about how to allocate your own capital and to grow your assets over time. So as always, you're welcome to do a totally free trial to see if it suits you. You can cancel anytime before 14 days, so you can come in and try it. You have really no excuse not to try it out. And if it doesn't work for you, you're welcome to unsubscribe, but if you like it, you stick around.